On Thursday, inflation came in cooler than expected. Headline CPI undershot forecasts. Core inflation eased more than the market anticipated. On paper, this looked like exactly the kind of data that should have pushed risk assets higher. Lower inflation, more room for rate cuts, a softer macro backdrop, and briefly, markets reacted the way people expected. Crypto bounced, risk appetite picked up, optimism returned, but it didn't hold. Within hours, prices stalled, then drifted back. Not collapsing, just losing momentum. And that reaction left many people asking the same question. If inflation is cooling, why didn't the move stick? The CPI print was strong, but it wasn't new information. For weeks, markets had already been positioned for disinflation to continue. Energy prices had softened, goods inflation had rolled over, financial conditions had already eased. So when CPI confirmed that trend, it didn't change expectations. It validated them. And markets don't tend to reprice aggressively on validation. They reprice when expectations are forced to change. This CPI didn't do that. Markets operate as a system of probabilities. Before CPI, the dominant expectation was already clear. Inflation was cooling. This data didn't rewrite that belief. It reduced uncertainty around it. That difference matters. Confirmation lowers risk, but it doesn't create urgency. And without urgency, capital doesn't need to move quickly. It can afford to wait. The initial reaction made sense. Short-term traders responded to the headline. Algorithms chased the surprise. Positioning adjusted briefly. But once that impulse passed, a deeper question took over. Did this data meaningfully change the policy path? And the answer was still unclear. Yes, it supports the idea of future easing, but it doesn't force it. There was no sudden shift in timelines, no shock to rates, no liquidity impulse. So the market paused. Right now, markets are less focused on what just happened and more focused on what comes next. They're watching whether labor market weakness accelerates, financial conditions tighten again, earnings begin to roll over, liquidity meaningfully increases. CPI contributes to that picture, but it doesn't complete it. Without confirmation from other areas, one data point isn't enough. This is where many people misread the market. Sideways price action often gets labeled as confusion. Most of the time, it isn't. It's a valuation. Capital isn't rushing in, but it isn't rushing out either. Leverage remains contained. Volatility stays compressed. Positioning looks cautious. That combination tells a clear story. The market isn't panicking, but it isn't convinced yet. This environment is frustrating. Good news doesn't reward. Bad news doesn't punish. Moves fade quickly. Breakouts struggle to hold. That doesn't mean the market is broken. It means expectations are stable, and stable expectations tend to produce patience, not momentum. For this balance to change, something has to apply pressure. That could be a clear acceleration in labor market weakness, a genuine liquidity impulse, a policy surprise, or a sudden tightening in financial conditions. Until then, there's little reason for the market to reprice aggressively. And right now, that pressure simply isn't there. So if you're wondering why a strong CPI didn't lead to a sustained move, this is why. Not because the data didn't matter, but because it didn't surprise the market enough. Markets don't move on good news. They move when expectations break.